traders and investors who can predict stock market crashes can also prepare adequately or hedge their portfolios to minimize the crash's impact on their share prices. When it comes to prices in the stock market, can you identify when a stock is excessively priced? What are some of the indicators then? In our video today, we discuss 10 ways to identify overpriced stocks in the market. Number 10. Current ratio. A company's current ratio measures its ability to pay off debts. It is calculated by simply dividing the company's assets by liabilities or measuring whether a firm has enough resources to meet its short-term obligations. A current ratio higher than 1 means typically the available assets can adequately cover liabilities. Higher the ratio, the higher the likelihood that the stock price will continue to rise even to the point of it becoming overvalued. Number 9. Price-to-book ratio. The price-to-book ratio is used to assess the current market price against the company's book value. The book value of equity is the value of a company's assets expressed on the balance sheet. The price-to-book ratio is the difference between the book value of assets, total assets, and the book value of liabilities. If a company has a PB of 3, it is trading 3 times its book value. The PB ratio is useful when considered in capital-intensive businesses, such as energy or transportation firms with significant assets on their sales, and in determining whether a company's market price corresponds to its balance sheets. Number 8. Debt-equity ratio. The DE ratio measures the relative contribution of the creditors and shareholders or owners in the capital employed in the business. It is indicative of the proportion of shareholders' equity and debt used to finance a company's assets. To establish this, the debt-equity ratio should always be measured against the average for its competitors. DE is calculated by dividing liabilities by stockholder equities. A good or bad ratio depends on comparing the DE ratios of companies within the same industry. The more debt a company uses, the higher the debt-equity ratio will be. DEs indicate the market's unprofitability, since creditors bear risks. Number 7. Reputation. The reputation of a company can be a significant determiner of the value of a stock. The market can overvalue stocks that high-profile individuals buy, especially if they attract much attention from high-profile or top industry players. Stock prices can be inflated. Capitalizing on the temporary overvaluation of a stock you already possess can be a good opportunity instead. Stocks with a lot of buzz around them should be carefully considered as they may be overpriced. Number 6. Return on equity. A lower return on equity, or ROE, indicates an overvalued stock. This would show that the company isn't generating a lot of income relative to the amount of shareholder investment. For ROE, a company's profitability is measured against equity, and return on equity can also be considered a return on assets minus liabilities. The ratio seeks to measure how effectively a company uses its resources to create profits from the assets used. Number 5. Relative dividend yield. The dividend yield is often used as a measure of stock valuation, and the dividend yield is a way for people to look at the price related to the profits. The price-to-dividend ratio is primarily used for analyzing dividend stocks and is very useful in comparing a stock's value against itself over time. P/D and valuation are inversely proportionate, and therefore, if the dividend yield is higher, the valuation will be lower. Most stock markets prefer high dividend-paying companies, even though it is not positive. Number 4. Price-to-sales ratio. One of the commonest ways to determine overpricing in the stock market is to calculate the current stock price by sales per share. This is popular because many companies make sales, and a high price-to-sale ratio means that the stock is expensive. The PS ratio is calculated by dividing the current stock price by the 12-month sales per share. Since companies will experience some level of growth, it is used by those who do not have earnings but revenue as a benchmark. Number 3. Compare PE ratio to competitors. A company trading at a higher PE ratio than its competitors might suggest that the price is overvalued. Consequently, if a stock has a lower PE ratio than most competitors, it may be undervalued and worth investing in after further research. For this particular one, further analysis is needed to determine the other additional factors that could impact the stock price. Number 2. Compare growth rate to P/E ratio. Popularized by Peter Lynch, the P/E growth ratio expands the limits by considering the growth factor of the company's earnings. The P/E ratio is calculated by dividing the P/E ratio by the company's EPS or earning per share growth estimate. A price-to-growth ratio above 1 indicates overpricing. The advantage of PEG is that it lets you compare stocks with different growth standards. Number 1. Earnings yield. The earnings yield is the inverse of the P/E ratio. In isolation, the earnings yield means nothing unless conjoined with the yield on government securities or safe bonds. For example, if a company's earnings yield is 4% and its bonds are yielding 7%, it is a clear case of overpriced stocks. The earning yield is calculated by dividing the earnings per share for the most recent 12-month period against the current market price per share. Investors use the earnings yield to determine overpricing or underpricing in a market. Thank you for once again watching this video. If you were able to make it this far, don't forget to click the subscribe button and check our other videos on stocks and the stock market. Till we come your way again, enjoy the rest of your time.